apartment building for 5 units and more. What is the difference between a loan for commercial property or apartment building more than 5 units? How do you qualify for the loan? What lenders like and what lenders don't like when they actually want to give you the money, the loan? What is the apartment loan process? In order for you to get a loan for apartment building, today we are going to talk about the loan for apartment building for 5 units and more. We are going to talk about how apartment loans differ from residential loans, that we are going to give you two main different, and how you qualify for that loan, and what lenders likes and what lender don't like when you're getting a loan. So based on that, you need to actually be ready and prepare for getting that loan. And what is a loan process? Because usually the loan process is a long 45 and more days process, which in that case you need to know step by step how and what document you should submit to the bank to make sure that you're getting that loan. So today we are going to talk about that, and we are going to couple of loans available for apartment building today that might help you to actually getting a loan a lot easier. And we're going to show you how you're actually closing a deal with no headaches. Okay, what is the difference between the loan for commercial property or apartment building more than 5 units and the loan for residential property? The apartment lender qualify the property first and then the borrower second. And when you're applying for residential, is exactly the opposite. They qualify you first and then they go look at the property after. What does exactly that mean? It means that when the lender want to give you the money for apartment building, which is commercial, they actually go and look at the financial statement of the property for past, let's say, 3-4 years. They look at the cash flow, they look at the property from outside, they look at the landscape, they look at the driveway, they look at the balcony. They want to know what exactly the property's condition is, and then they go and look at your credit after, which is not as important as the property. So it's very important when you want to actually buy the property, you go and look at it, and you go through all the process and find out that you can actually get the loan for the property. So this is very important. And the second one is the down payment for actually commercial property or multifamily apartment is a lot higher than residential property. Usually for, let's say, a single family house or a duplex or triplex, you actually need 5 to 10% or maybe 20% to put down as a down payment. But usually for apartment building, you need, in most of the cases, 30 to 35 or maybe even 40% down payment for your purchase. And this is the main second difference that you have in multifamily apartment building. Okay, how do you qualify for the loan? When you're going to the bank look at 3 C's to actually qualify you for the purchase. What are those 3 C's? We are going to talk about each one of them. The first one is cash flow. The bank want to see that your income from the property, from the apartment, is more than your expenses plus your mortgages. What does that mean? For example, let's say you have 25 units apartment, you have some expenses, you have the management fee, you have utilities, you have property tax, and you have your mortgage payment. The rent that you're collecting from that property should be minus all the expenses, and your actually mortgage payment should be more than 1.2% of all the expenses. We call that debt cover ratio, or DCR. In debt cover ratio, it actually shows the bank that all the income from the property minus all the expenses, including mortgages, is actually 1.2 times more. The ratio should be 1.2. It means that your income from that property minus all the expenses and your mortgage payment should be over 1.2%. This is very important for the bank, and this is the first thing that they're looking at it when they're coming to analyze the deal to see if you'll be able to actually get a loan for a property. The other C important things for the bank is collateral. They are looking at two collateral. One is your property. The other one is your down payment. The first collateral, which is your property, which is actually the amount of loan to value. Usually this loan to value plays a very important role when you want to go apply for the mortgage, apply for a loan for your property, because if your loan to value is almost 70% or 80%, that means that you're getting a loan 70% of the value of the property, or 80% of your property. And if it's actually 90%, that means the loan to value is 90%, which actually gives the bank actually more collateral on your property, and they can approve you a lot easier. So if your loan to value is actually more than 80% or more than 70%, the bank would give you the loan a lot easier and more comfortable, and they are actually trying to give you the higher loan to value, and it's actually depends to the bank as well. So the third C that the bank look at it before they give you the mortgage is your credit. So this is the last thing that they're looking. So they actually look at the property first, they look at the cash flow, collateral, and at the end they look at your credit. In your credit, you should have the score more than 660. You should have no bankruptcy if they want to approve you. They actually they don't want any like foreclosure or anything like that in your credit. They don't want you to have any open judgment in your credit, and they want to see a good net worth when they're actually looking at your credit, because when they want to approve you for the loan, other than the property that they're getting a loan at, they're actually looking at your net worth, how many properties and how much money you got, because just in case if anything goes wrong, they can go and look for that net worth, and they would be more safe when they're actually looking at your credit with the good score and good net worth. Okay, now we are going to talk about what lenders like and what lenders don't like when they actually want to give you the money, the loan. The lender likes the solid cash flow for the property. They want to see a good financial statement for past, let's say, 3, 4, 5 years. So if the cash flow is solid, if they realize that the cash flow was there for almost 3, 4 years, they actually give you the money a lot easier than a property which doesn't have a good solid cash flow. And they want to know if the price that you're purchasing right now is actually lower than market price, because nobody want to give you the money when your price is higher than market price. So this is the second important thing. So you have to make sure that the price that you're purchasing your apartment building is actually like lower than market price. And the other thing is the evidence of like good apartment history. They want to see the history of the apartment financially, and based on the income and expenses that you're getting from the seller. And usually when you're getting that from the seller, you have to review it yourself, make sure that they're not fake, and all the evidence of the expenses and the income is there for you to actually do the research and make sure that this is the right property to invest at. So this is very important for bank as well. And what the bank don't like in the property is having a poor financial records, or being poor maintained property, and the weak market. What are those, and how we can explain each one of them? As I told you, the poor financing records, which bank would realize it itself and analyze it itself, it shows that the property didn't have a very good document for financing, and this is a red flag for the bank. Poorly maintained property is the other thing that when the inspector would go and inspect the property, if they realize that they're very much poor maintained property, and if they realize that the property maintained very, very badly, this is a very bad sign and red flag for banks as well. And the weak market. If we are going through recession pretty soon, or if they realize that the market is not booming like before, this is a red flag as well, because they might say, okay, if you guys invest in that apartment building and later on anything goes wrong, what's going to happen to the loan that they're giving you? So these are three things that they actually don't like when they want to give you the money. Okay, what is the apartment loan process? And we want to give you the exact step-by-step of the process of getting a loan for the commercial apartment building. First, you have to send your financial document and your at least 12 photos of the property to the bank. When we are saying financial document, we are referring to the real document that you are actually getting it from the seller, and you actually analyze it yourself. That is not fake, because in most of the cases, the financial statement that you are getting it from the seller is not a right information. You can get T12 or T7 or T3. What does that mean? T12 means your financial statement in past 12 months. T7 means your financial statements in past 7 years. Sorry, the first one was 12 years, and this is a 7 years. And T3 means your financial statement for past 3 years. So T means the number of years that that financial made for, like T12 is for 12 years, T7 is for past 7 years, and so on. So you have to make sure that your financial statement is pretty much accurate and correct, and you attach that with 12 photos of the property, and you send it to the bank, you submit it to the bank, and they review your credit after they receive that document with financial statement. They review your document after, and they make sure that your credit is good enough for the property that you're purchasing at. So as I told you, the property is more important than your credit, so they review the document of the property first, and then they go and they review your credit after, and then they order appraiser or inspector to come and inspect the property to make sure that the property is actually purchased at the right price, and it's not poor maintained, and the seller did a good management before you're purchasing it. And then you can go and register and lock the rate and do the other step after, which after you register and lock the rate, they actually go and do more underwriting on the deal. So the bank underwrite the deal with more details to make sure that this is a right property to actually give a loan at, and they order title after, and they approve you for the loan or not approve you. At that point, if they don't approve you for the loan, they ask for more document. And that document, it depends of the property that you're purchasing is different. So they might ask you for more photos, they might ask you for more backup document for financial statement. They ask you for a lot of more document if they realize that the document is not good enough. And then they go and finalize the deal with you, finalize the closing, which at that point your lawyer, you yourself, and the bank work together in order for the loan to be ready for the closing date. And on closing date, you would close the deal and you get the loan, and everything is done at that point. In order for you to get a loan for apartment building, you can either go to mortgage broker to actually make your document ready and make sure everything is in order and submit that to the bank, or you can go to local bank and do it yourself. So as an investor, if you just start to investing in apartment building, I very much recommend that you do your first couple of deals with your mortgage broker to make sure that you know what kind of document and how You submit that and learn from your mortgage broker in first couple of years, and then after, when you got used to it, you can do it yourself. You can go to your local bank or the actually lender that you used before and you had a credit with, and you can get a loan with them again, a lot easier. So that's the two approach that you can use to get the loan for apartment building. Thank you very much for your time and hope to see you again.